known as decentralized autonomous organizations are generating a lot of eye rolls thanks to high flexibility and low regulation. They'll also soon generate a lot of profits. This is an incredibly risky move. I don't know if I agree with it. The founder of a company named Artblocks in the risk-oblivious field, non-fungible tokens, was nonetheless concerned. It was February 2021, and he was one of 59 investors who had banded together to potentially buy a rare set of 150 popular NFTs, CryptoPunks, directly from their producer. The group, a decentralized autonomous organization called Flamingo, had pooled $10 million to meet weekly via Zoom, audio only to protect those wanting anonymity, to figure out what to do with it. The CryptoPunk opportunity at about 4 Ether, $7,200 at the time, per punk, would eat 10% of that, which is partly why he aired his concerns on the group's Discord channel. The tension got thicker when members discovered one of their own, someone going by the pseudonym Pranksky, had tried to front run the deal, opening a back channel to buy 150 punks for himself. In the end, Flamingo members voted to spring for the punks, which were recently valued at $30 million. As for Pranksky, he left the DAO by mutual agreement, telling Forbes he was somewhat naive about the DAO process. Most of America is. Sure, you're probably familiar with the concept leaderless collectives in which groups democratically make investment decisions, such as when 17,000 members of a DAO tried to buy one of the 13 surviving original copies of the U.S. Constitution last year. We talked about that case. They raised that money. That unfortunately did not buy it. The Illinois billionaire bought it, but it was interesting that people got together and crowdfunded this investment, which was millions of dollars. The CEO and co-founder of Tribute Labs, which set up the Flamingo, calls the DAO a subreddit with a bank account. But while the headlines tends toward the splashy or the silly, a new model is emerging that has real legs as an alternative investment vehicle. A quarter century ago, an Illinois investment club run out of the church basement, the Beardstown Ladies, spawned a slew of bestsellers and imitators as stock picking groups proliferated. DAOs have modernized and digitalized the concept, incorporating many of the traits that make the blockchain so potent. By using tokens, DAOs can effectively allow voters, empower profit sharing, and crucially, supply liquidity, as tokens can be bought and sold. Though for now, trading in tokens is not something the Securities and Exchange Commission is ready to bless. By limiting membership to 100 people or fewer, some DAOs are also able to skirt SEC rules, since they fall under the quaint 82-year-old investment club exemption, so long as the participants are all involved in managing their kitty and don't publicly offer their securities. And while the leaderless model can be called by another definition anarchy, it also lets those interested in alternative assets play without having to outrun the 20% profit share that hedge fund, venture capital, and private equity managers regularly charge for what too often is average performance. Syndicate, which makes DAO in a box software, partners with another startup that can help you do all the legal and tax paperwork for $2,000 a year. While Tribute charges 2% a year of the DAO's original investment to do all the paperwork and incorporate things like coordinating group calls, not coincidentally the same upfront vig that funds charge. The difference here is that the profits are all yours. Combine all that and you have something that can't be judged by all the dumb headlines. Instead, think of DAOs as a legal platform, much as nimble LLCs emerged decades ago as an easier way to incorporate than the lawyer-laden C corporation. The early adopters might seem silly. The second wave will make it mainstream. Exhibit A, Shah is a partner of a VC firm, Blockchain Capital, in San Francisco, which has a traditional fee structure on $1.8 billion under management. Nevertheless, he co-founded a DAO called the Collective, which has 35 female investors, $400,000 in capital, and a goal of investing in crypto startups with female and non-binary founders. In creating an investment vehicle, leveraging syndicate services that isn't weighed down by institutional investors or high hurdle fees. He says the DAO can have a lot more experimentation and flexibility, and those are two terms that tend to portend exponential growth. growth. The early days of DAOs did a model no favors. In 2006, early adopters of Ethereum formed the DAO to back crypto projects, quickly attracted $150 million, and then lost 1/3 of that to a hacker before making a single investment. While the attacker was denied most of his spoils after developers controversially forked Ethereum, the point had been made. The DAO disbanded, and all DAOs carried a stink akin to that of the early dark web marketplace Silk Road. Nevertheless, the concept gradually spread.